the beginning of markets. What was a market, and when did the market that we refer to it today? Because if you're talking to anybody, you know, what the market do today? And they're talking about the stock market, but that certainly was not always the case.
Well, it certainly wasn't the case. So when you talk about markets, I mean, markets themselves, think about, you know, the most traditional form of it is just you go to a souk, right? Or you go to a market where people are selling wares. You're effectively bringing together those who have acquired goods and those who are seeking goods, right? That's all a stock market is. It's just a market that happens to be for pieces of paper that represent various corporate entities, right? And so most people tend to forget that history. They think of it as differently than going to the store, because it is actually different, right? Very few of us grew up in an environment where we had exposure to a souk or a flea market sort of environment where there's negotiating and haggling that's going on. But that's all the stock market is it's effectively the meeting of people who want to haggle over the price of those pieces of paper, what we refer to as Q. And so the data that we see on markets is actually just a history of transactions that have occurred in those markets, right? And that's kind of one of the important things to remember as we think about what markets are doing. There's buyers and there's sellers. We only see the intersection of those two where a transaction actually occurs. We don't have any data in terms of what was the market depth. We don't know how deep was the market prior to the crash of 1987. We don't know how deep was the market prior to the crash in 1929. We don't know what the tipping point was in terms of those underlying components. And for me, that's the most interesting part about markets, is trying to actually understand what happens when you step just outside of where that transaction occurred. If it had gone another point, if it had gone 2 more points, was there depth that then would have created a discontinuity? And that was really, for me, the most interesting thing that I've learned since coming out of the theoretical background in college, is all of the models that we use and that we assume when we think about markets, when we talk about efficient market hypothesis, or we talk about modern portfolio theory, or we talk about the crash of 1987 and the assumptions that sat behind it, the assumptions are one of a continuous market where you can always transact. And what 1987 really was a discontinuous market. It was a market where the next transaction was so large that nobody was willing to stand in front of it.
So when did the modern stock market, as we think of it, was this a moment under a tree in New York, in front of the New York Stock Exchange as we know it today? Did it precede that?
Well, there are histories of stock markets that go back to the early 1600s, right? So we have the examples of the Dutch stock market with the Dutch East India Company, et cetera. So those have been around for 400 or 500 years. But when we talk about a modern stock market, right, there's a contemporary stock market. There's never a modern stock market, right? It's constantly undergoing evolution. And so if you look back to the Buttonwood Tree, and I think it was 1789 in terms of the founding of the New York Stock Exchange, or what they label as the founding of the New York Stock Exchange, you were trading claims on companies, primarily fixed income. There was some element of equity trading that was going on. Equity did not resemble what we talk about today. They were, in many situations, full liability corporations. So your analysis would have to include, could you be sued or could you be held liable for the debts that were incurred by this entity over and above the capital that had been invested? And those things have changed over the past 200 years, right? The rules of what we're transacting, the definition of what we're transacting, the obligations and rights associated with that have all changed. In its most modern, form, to use the language that you describe, I would suggest that most of what we think of as the stock market today kind of began in the early 1980s with the introduction of products like futures, with the introduction of liquid option markets, and a tremendous growth of both fixed income and equity markets on exchanges that might not have existed prior to that, right? Pink sheets, for example, were actually a real thing, and there were many companies that were not actively traded on exchanges. Those rules began to change quite dramatically with the introduction of the dealer brokerage market, the NASDAQ, right? The National Association of Securities Dealers, which created markets for those, et cetera. So I kind of would put it back to that 1981, 1982 time period, which of course feels like the beginning of the first, great bull market, which I might suggest has actually continued. But that would kind of be where I would start if you're starting to think about it. And again, I was just very fortunate to come into a theoretical understanding of that at a relatively young age, kind of 12 years, 10 years into the modern market to again, use the lexicon.
So along those same lines, when was the S&P 500? When did that come about? In fact, probably the next person I interview after you is going to be a dear friend of mine, Howard Silverblatt, he's only been with S&P for, I think, 43 or 44 years now. He's a walking, talking spreadsheet. It's just frightful. And when there's a shift in this index, it's a monumental moment inside S&P. But how long has the spider, $SPX, how long has that existed?
So the S&P itself was created in 1957. At the time, it had only 200 stocks in the index, and then it was widened to 500 stocks. In a tradable format, there used to be a product referred to as, in the initial introduction of futures, there was something called the OEX, which was the S&P 100. That was far more liquid in terms of trading activity than the S&P 500 was, in large part because the calculation intensity, the ability to get a computer to very quickly run a replication or an arbitrage construction on 500 stocks was far more difficult than to do it on 100 stocks. Gives you some idea of the advances that have occurred in our lifetimes.
Mainframes used to take up entire rooms.
Exactly. I very distinctly remember sitting in a investment training course at Spearleads and Kellogg, where I worked when I was at Penn. And a representative from Merrill Lynch came in and explained that the street now had a full petabyte of information in terms of data that had been collected, in terms of the total amount of information that was available on Wall Street, right? And you stop and you think about how quaint that is today relative to, we're all sitting around on our desktops at the time. I think the IBM AT had just come out and had a 30 megabyte hard drive, right? And so, that's a small email attachment today.
Yep.
So the world has changed quite dramatically over that time period, but the SPX began in 1957. It was introduced in futures form in 1982. We can talk through some of these components, but one of my favorite references is actually going back to that point. Warren Buffett, in a 1982 commentary to the SEC that actually was then published in Business Week magazine, another somewhat archaic reference, after the crash in 1987. It was brought to light that Warren Buffett's commentary on futures was, he could see, a quote is, "I see logical risk-reducing strategy that involves shorting the futures contract. I see no corresponding investment or hedging strategy whatsoever on the long side."
Wow.
Right? And so when you think about futures and kind of the swashbuckling, Paul Tudor Jones of the 1980s, what was really going on with futures throughout that entire time period is that they were the province of commodity traders. They were the province of people who were either looking to hedge out their risk. Jim Chanos famously started Kinnikos Advisors using futures to offset the equity market exposure, exposing his alpha, for example. But nobody really had a use for futures for another almost 14 years, 13 years. It wasn't really until the mid-1990s that we began to use them in something that resembles their current form, where significant use was created on the long side.